right now we're focused on the overall outlook for the markets in 2013. And joining us now to give us his take is Barry James, President and CEO of James Advantage Funds, which has $3.5 billion of assets under management. Barry, thanks for joining us.
Hi, glad to be here.
Well, Barry, U.S. markets kicked off the year with a bang, the S&P 500 reaching its best high in 5 years, pulling back some gains a little this week, coming back with some modest steps into the green today. What is your overall outlook for the markets this year?
Well, we see a lot of volatility this year. Last year we had 2 times where the market was up over 10% and 1 time when it was down over 10%. We're back in another one of those runs at another 10%, and we think that's going to continue. We don't think we're in a new bull market. We don't think that the long-term valuations really set us on the edge to really take off to extreme new highs, and we have a lot of negatives that we're facing. While we have a positive in quantitative easing helping the market and forcing people out of savings accounts, at the same time, what we see is the job situation isn't very good right now. We've got a big new tax hike that just came on board, and it's a year after the presidential election, and those tend to be the worst in the whole 4-year cycle for stocks.
So I'm going to put your feet to the fire. Give me a number that you see the S&P 500 at, or a percentage increase or decrease by year end.
I know it'll be wrong by come the end of the year, but maybe somewhere between 5 and 10%. But lots and lots of volatility. It won't be a straight line. It won't be easy for people to sit through.
Well, let's focus on this quarter. We had fourth quarter earnings kicked off yesterday with Alcoa. How do you think the results are going to impact the markets this coming quarter, and what do you think is your outlook for corporate earnings?
Well, there's not a lot expected on the street, maybe 2.9% earnings growth, which is not very much in support of higher stock prices. So anything that comes out better than that, it would actually give a boost to stocks. So we may actually see that trickle through. The fly in the ointment, if you will, is the fact that revenues have not been growing as fast as earnings, which means companies have been cutting personnel and doing other things to cut costs, but you can't do that forever. And that's one of the reasons why we see the slowdown in earnings. That will eventually catch up with the market, and we'll probably see a dip, but maybe not in the first quarter.
Now, some sectors that you do not think are dipping, but that will be rising, that you've highlighted, are autos and home builders. Now, they've had a pretty good run so far. Why do you think there's still more room on the upside? Well,
one of the things we believe in is that you want to buy companies that the stocks are going up, the earnings are going up, and they're not too expensive. And while, you know, home builders had a great year, the best of anybody last year, they're still cheap, and their earnings are just starting to turn around. So they have a lot of room to grow. You look at homes, home sales are going up, home prices are going up, and traffic is going up, all good signs.
So you're obviously optimistic about the housing market then?
Right. Exactly. We think that it has bottomed out. It is turning the corner. These low interest rates, and people can either refinance or buy a new home. Banks are actually lending once again, even out there in the Midwest where I'm from.
And you say banks, and one of the other sectors that you're bullish about is the banking sector. We've had the top 10 banks kind of putting aside the whole mortgage debacle chapter. How do you think that's going to impact bank stocks going forward?
Well, we think they're in a prime position right now. Until the Fed starts to raise those short-term rates, they're making over 3% on the spread between what they can lend it at and what they borrow the money for. So they're printing money, maybe not as fast as our government's doing, but they're still printing money pretty fast.
Now, you're talking about printing money. You've mentioned the Fed hinting recently that QE3 is going to come to an end. What are your thoughts on that?
You know, we've done a lot of research on the quantitative easing, and it hasn't worked as far as boosting the economy. 1.5% growth, which is way below normal for the U.S. If you look at Japan, which has done it for many, many more years, they haven't had growth. So it's not necessarily a panacea. It doesn't help bonds, except when they stop quantitative easing, then bond prices go up and yields go down. So we shouldn't see much help for bonds here in the near term. But stocks, it's a winner. You'll see 20% annualized rates of return in quantitative easing.
But yet you're saying that your overall outlook for the markets is for stocks to go down. So that kind of goes hand in hand with QE3 coming to an end as well?
Well, that may be. We try to measure risk in the market. And one of the things that we see is the sentiment has started to change. People are getting much more bullish about stocks. And that's typically nearer the end of a rally than it is at the bottom.
Now, very quickly, I want to touch on some fiscal policy. We barely averted that fiscal cliff. We touched on taxes, but government really didn't do too much with spending. and now we've got the debt ceiling to deal with over there. How do you think the forthcoming debate and debacle with the debt ceiling is going to affect markets over the next 2 months?
Well, I think there's a lot of pessimism built in. Maybe not as much as should be there, because the guys in Washington don't seem to be able to get their act together one way or the other. So we're going to see more drama, but in the end, they are not going to let us go over any sort of a cliff and let our ratings drop or anything of that nature. We have a printing press in the United States. We're going to be solvent. We're going to pay our debts, and they will raise the ceiling eventually. And it'll cause some scares along the way, maybe something that would trigger be a catalyst for a pullback in the market for a period of time. But I think maybe once you get past that, probably another good buying opportunity.
Okay, thank you so much for that insight, Barry James of James Advantage Fund.